Hello, Warriors. Michael, how are you? Ingmar, how you doing, Bran? AJ, I agree with you. I concur. Let's have a good week. Remember, the operating word as a trader is next. Let's make a promise to ourselves. We're not going to dwell on something that we didn't do perfectly this week. Anyone with me on that? Because it happens all the time. And if you want longevity in the business, you have to learn to let it go and just move on, or it'll affect your health. You guys with me?
Amen.
Okay. Thanks, Scott. Yeah, Bitcoin is bouncing a little bit today. Perfect is rare. Okay, so yeah, sometimes my entries are, and I've seen the guys here, the team, their entries are spot on, very minimal drawdown, and it goes right to target. But you have to, even though you can do that, you have to understand it's the exception, right? Not the rule. So anyway, pretty flat board, Ryan. How are you? Euro up 13, euro pound up, 17. So I'm, tempted to fade the dollar. I'm torn if we're going to put in a higher low. Normally in a bear market or a market that, hasn't bottomed, usually doesn't take that long to just, flush again. So I'm wondering if, what we're doing here is consolidating the gains, and it may not be today, but we end up putting a higher low in the dollar, and just something to be aware of in both the euro and the pound, just based on the weekly. I know it's important to me. We had inside weeks in euro. See that candle inside of last week's range? Okay. And similar in pound, inside week. So under last week's lows would be vulnerable. So I'm not making a call on this, but the most bearish thing the euro could do, doesn't have to take out this high. But if we've already taken out last week's highs, and then later in the week or whenever take out last week's lows, then you have a pretty bearish candle. So just something to be alert for. S&Ps are completely just quiet. I feel like they have to come out of here and either, really hurt the bears and get going, or, this is a pretty important line to me. These, this horizontal line, 40.74-ish. And gold, I'm not ready to buy it. Not ready to buy it. This looks like, doesn't look kind of like a head and shoulders or a descending triangle in silver. And it's about $1.50 range. Would take it down, a measured move under here would take it to 23. So that's about it. I was thinking about this. Guys know I follow stocks. Well, Apple is the whole banana. Okay.
Fruit salad.
You like that one? Yeah, it's a whole banana. And, tried to stage a breakout last week. Maybe it'll go back above the line. But when you think about it, it's the only FANG name that hasn't been hit, right? We know Facebook got hit, and Netflix and Google, they all got hit. Or MAGA, which is Microsoft, Apple, Microsoft hanging on by a thread. But anyway, I'm, watch this Apple for maybe a reversal week, and maybe it was a clue. S&P's finished pretty much unchanged to higher, and Apple was still lower on Friday. And the other thing that, makes me very cautious on the market, Apple and Microsoft, that's a lot of market cap in the averages, right? So, you know what I teach about, not trusting breakouts that do this and say, oh, here's the breakout, but you missed it. I'll let you buy it again. Oh, you thought you missed it? Here, I'll let you buy it again. Oh, you thought I missed it? Mr. Market is giving people too many opportunities here. And if you're just a pure technician, I think we have a breakout failure under like 282 here in Microsoft. So if you get Microsoft and Apple to roll over, that's going to put some pressure on the market. So, and they both look like they could. I'm not saying they will today, but where they will here. Microsoft is much closer to a breakout failure than Apple. I mean, you know what Apple is to people in the markets, stock traders, devout stock traders. It's their version of gold. It held up pretty well during the decline last year, had this one false break, but people look at it as flight to safety is their goal. Gold, it's, flight to quality. Okay, so we'll see what the Chinese
I love
have.
that. I love that Microsoft chart.
Yeah.
That you just put up there. It's we talk about fundamentals, we talk about this, we talk about technicals, and sometimes you just get a simple chart. One line, one level. You know what to do. If you wanna be long, you be long above the level. If you want to be short, you be short on a break of the level.
Yeah.
It's one line. That's all you need.
Yeah. Yeah. So Ryan, are you telling me I don't need like 10 big screens to trade Microsoft?
Well, that's where it gets interesting, because we like to make it complicated, don't we? So we like to know what's going on at Microsoft. We like to know what's going on in the fundamental picture, but sometimes you can just bring it down to absolute basics, and there you go. And you could take the name off the chart. Right. It could be anything, any asset in the world.
Exactly.
There you go. There's price action.
Exactly. So
if you do that, if people can learn to trade things like that, you can trade anything in the world.
Right. The only difference might be beta and the leverage it offers, or that you can control. That's it. Same thing. So I have Jamie McGeever coming in from Reuters, and he wants to talk about the BOJ. Kman, you want to talk about what you're thinking about, and anything you want me, you guys, Ryan or Kman, that you want me to ask Jamie?
Well, I mean, to me, the base case is still they are not going to change anything to the monetary policy right now. And then the only open question really that we have now is that in the light of what the radar said, and that they would not be in a hurry, the surprise trade would be that they talk about something specific. They may talk about that they are looking at stuff, how they are going to handle it, but they should really. But I don't have any really specific question unless he knows what the Japanese whales are going to do in this fiscal year.
Okay, I'll ask him if he knows.
With the foreign bonds, but that's a lot of it is guesswork for now. But
ask him if he knows Moby Dick. Huh? I mean, I look at the end here, bro, and I mean, it keeps chugging along every time there's a little dip. And it looks like it wants that daily 200 up there.
I think if there's absolutely no change in this week's Bank of Japan, it's possible we get there. Especially that it's not only the dollar yen that is supported; it's the euro yen is supported like hell. I mean, the euro crosses are extremely big, and I've been saying that for about a month and a half. We had this dip in between, but then once the dip is digested, we're 150 points above Thursday's low that's 1% in the euro yen. And if you look at euro Aussie, euro Kiwi, euro CAD, you name it, they're all going the same way. It's the euro dragging everything around for now.
Yeah. So I
But
can't make a call.
I mean, the surprise trade would be that they do effectively something this meeting, but it's far too early, and if and I don't see with the deputy governors they are there that they will change anything this week at all. But we never know what they talk about, right?
Yeah.
Because the day they change, then the yen will move because it's such a big market and it impacts a lot of different assets.
Okay. Aussie, still the weak sister. Anyone have a reason for why Aussie is underperforming against the dollar? I mean, we really haven't had big risk off. Commodity prices have come down a little bit, but they also soared. That really didn't support Aussie. Is Aussie telling us something about China? About commodities?
Not right now.
I
don't think there's the direct correlation. It may be, but I don't think the market is trading the direct correlation right now.
Okay.
I just think it's also a factor of what's happening. Look at the Aussie, the Kiwi, the CAD haven't moved materially. Sterling either, but that's perhaps a different one. But yeah, I mean it's all about euro strength. So the rest, and we had a perfect example of it again this morning. The rest isn't moving.
Right.
Even the dollar remaining quite bid versus those other currencies, but it's really the euro benefiting from everything.
Yeah, some type of big formation here happening in Canada. Some kind of triangle. So we'll see. It held again. So there's something developing here. We'll start to get some compression, I think. So that's your weekly look at it. But it doesn't look bad enough that I want to short it. So I don't know.
It's playing a nice range.
And there's there's a couple of more bucks to go for the oil to fill the
Oil?
OPEC gap. So that may be where your dollar CAD may top out, or your Canadian dollar bottom versus a few things.
It's a good point. Are you going to buy the pullback into the gap?
I don't know whether for the time being my drawer where my butcher's glove is in to catch a knife is still closed, so I'm waiting.
Okay. Yeah, I mean this would be the area, to try it. It doesn't have to fill it. In fact, it'd be more bullish if it didn't fill it.
Yeah, that's true.
So, something like this. I was talking to a trader buddy of mine when crypto was starting to look tenuous, and I talked about coin. And coin, everyone's waiting for it to rally into the gap, and it only rallied halfway into the gap, which you see turned out to be more bearish than if it had filled the gap. So just a rule on gaps is more bearish if the market that you're looking at cannot fill that gap and leaves it behind. How you doing, Stel? Are you around today?
I'm very well, thank you. Yes, I am here.
Okay, so
good. What I'm looking at is really the S&P. It got really close to the 4110, 4115 area of support. Held again. So
that was a 2-week off number.
Oh, is it? Okay.
I mean, it is interesting, and still surprises me, even though I see it all the time, that the off number last week was there. 4115 was a 2-week off number. So it didn't have a reversal because it held, 4115, took it out a little bit here, 4112, but now it's up here this week. It's up around, I don't know, 4150. So, I mean, does this trend line mean anything? I mean, it's trading underneath it, but hasn't done anything.
Yeah, I still think that the pain trade is higher both in the S&P and in the euro dollar. And these things, the dollar and stocks usually go opposite. So as long as the dollar cannot rally, then I don't see how stocks can have
go down.
Go down. But basically, having said that, we are really close, right? 41.15. Well, actually, we got to 41.15. Yeah, the lows of the day. So it's close, but again, it's holding. So for now, and as long as we are above that, I think it's buy on dips for both the S&P and the euro dollar. And might not make too much sense, but I think that's what we have as a market at the moment. And I think that's how we trade it.
Okay.
Yeah, but we have core PCE this week. Definitely going to be adding some color to the whole picture and see what the Fed says. The data overall in the US, it's been very mixed. That we were getting more and more negative surprises, but there are a few fireworks where we get some positive numbers. So I think on
GDP this week too, right?
Yes, that's true. I think on balance, it's starting to look worse in terms of economic data, but the part that's been resilient, which is employment, and it's a lagging indicator, obviously, is still doing well enough for the Fed not to throw in the towel. But this could change, pretty quickly.
Yeah.
So let's see. It's a difficult one. For now, I think that's the path of least resistance. So buy on dips in euro dollar and stocks
and S&Ps.
Yeah.
Okay. And so far we're holding Welsh's 103 on TLT. So this too is getting close to is it going to break out or fail? We're real close there. And 10-year. When I was on with Kman last week, Friday, I said I had to hold 350, and it bounced pretty good off 350, but I don't know, maybe it's going to challenge it again. I don't know. Any view on yields, guys? I mean, they look flat to me.
Still,
I don't know.
They look a bit soggy.
Still soggy. So
if you look at that two-year yield.
I don't have that chart.
Level.
Oh, okay. All right.
4.26 and failed.
So we don't have the Fed for a few weeks.
Yes, we're in blackout.
Okay.
No squawkers until next week.
Okay. I still think that there, what's going to might shake the market up is going to be this debt ceiling deal. I know, because everyone thinks it'll just be theatrics, but
I don't disagree with you, Dale. It's going to be a lot of jockeying around, a lot of volatility as a result, I think.
Yeah. So, with this Congress, Blake, anything can happen. It's not like, how it's been. It's more polarized than ever. So,
100% agree.
So anyway, what an experience you went through,
Yeah.
Snakes on a plane.
Yeah, that was, it's funny. Stelios said my leaving the desk and getting away did lead to some volatility, but it was plane volatility, which, when I was actually on the plane dealing with turbulence, I think the markets were actually moving quite aggressively at that point in time too. So
yeah.
Anyway, so Stelios, well said. With plane volatility, that was.
I have my moments.
Yeah, no, that was good. No, I actually think the debt ceiling, Dale, is going to be a real big issue. I guess the question, and I'd love to ask like what everybody else thinks. Does it rock confidence in the dollar? I mean, yeah, you would think risk markets would get hit, right?
Yeah.
But is the dollar really going to come under pressure, or does the dollar get bought? I think like the best trade in currencies is sell dollars, maybe buy the yen, because if the yen, you have some risk of adjustment of yield curve control at some point. You would think that the BOJ is going to eventually come off, and start raising rates at some point in some way, shape, or form. That's like the bigger risk of the yen longer term. Whether it's this month or 6 months from now, who knows? But the dollar, will it get sold? I wouldn't want to own dollars. I don't think. Yes.
Sorry to interrupt. I think you're absolutely right, with the exception that if this hasn't happened already 20 times in the last 10 years of whatever, I would be agreeing with you. But now I think everybody knows debt ceiling is going to be raised, debt's going to be monetized. We keep going, we keep spending, we keep printing, right? I mean, who disagrees with that? It's hard to disagree.
Well, that's the thing, and that's I think what Dale and Dale. I can take the charts if you want.
Okay, buddy.
Yeah,
I just want to show everyone this is Steve's breakout line in platinum. So if you're looking for a pullback, I think it's 1075, right? Stell, isn't this Steve's line?
I think so. Yeah.
Don't trust that guy. He doesn't know.
He's the guy with the Russian accent. Okay,
yes, exactly.
All right, there it is, 1075.
All right. Now, going back to the debt ceiling comments, though, and what you're saying, Stelios, normally I would say yes, but maybe you haven't seen or maybe felt the U.S. political system as of late, and the contentiousness between the far right and far left is it's at a peak where we could force the hand of really not getting anything done and pushing us into a point where we really start to actually not pay some bills and default on some things and start cutting back, like certain services get cut off. And I'm not, I actually do think that this could happen. This is a real
my favorite always with the debt ceiling is the line they keep repeating. We have to raise the debt ceiling so we can keep paying our debts, which is the absolute oxymoron, right? Because if you pay your debts, you don't need to raise the debt ceiling. You need to raise the debt ceiling so you keep not paying your debts.
So what they mean is so we don't default.
Yeah, I mean,
but you don't increase your debt by paying off your debts. You actually need to accumulate more debt to increase your debt.
Oh, that's not what I learned in college. No,
let's think about what the trade is and why, what can happen. And like I said, I'm in a belief that stocks can go higher, but yields are going to fly. I mean, bonds are going to get dumped. You're going to see yields just rocket higher. But do you buy the dollar when yields are going up in that situation? And my answer is no. you don't. And that's going to be it's something that we sat. I could probably go back. I could probably date us back 10, 12 years of me talking with other people, and I'm like, it's really going to be a scary day when you see U.S. equities under pressure, and you're going to see the bond market under pressure, but the dollar under pressure as well. And so, and this might actually be a situation that we get ourselves into.
Let me tell you why it won't be, Blake.
Okay, please do. I mean, this is where I want to hear the debate here, and I want to hear what you guys think. So,
right. First of all, we shouldn't rule out any market moves on the the chess beating and all the poker game, as Stell called it this morning. The to and fro between the parties. But the reason it won't be an issue, and they will agree to kick the can, is because you've got an election year next year. No one's going to carry over a big, huge shutdowns and all that sort of stuff into an election year. So they'll
blame it on each other.
Yeah, but then they'll kick the can into next year after the election, and then they'll get into that, and then you might get an issue where a shutdown is more real.
See,
they're not gonna, they shoot themselves in the foot if they do it before an election.
But they'll blame it on each other, like because this is a
Democrats will blame Republicans, and
Republican plan is being put forward, and it won't pass both the House and the Senate. And they're going to say, well, it was your fault, and then it's your fault. The thing is it's going to put, without brinkmanship, it's going to push us over the ledge to a point where we start defaulting on things, and then of course they will, you know, in the 11th hour or even after the 11th hour, at the 1 o'clock hour, once we're past our deadline and things start to get rocked, they'll come to a solution, and then you reverse everything right after that. But
not if there's a downgrade like last time. You don't reverse a downgrade.
Yeah, you won't. But there will be.
Although don't forget, Dale, that the previous time only Standard & Poor's, if I remember, had downgraded the US. Moody's. Yes, you're right. It was Moody's. You're right. And if I remember right, the
bonds rallied.
That's one. Yes, that was indeed a funny outcome, but it was an outcome. But if I remember right, the thank you for being somewhat more honest than the rest was they hit them with some kind of a huge fine soon after that. So I'm not sure anybody else is brave enough to do it.
Oh, I didn't know that.
Oh yeah. They had gone after them conveniently, extremely soon after, and they were hit by a massive fine.
Oh.
So what's the trade going to be? I think just this like volatility that we're going to be heading into the next several weeks as a result of this is going to shake up the markets at these levels. That's why, Stelios, I hear what you're saying about the pain trade, and that's been the right trade for the last several weeks, but that was several weeks ago. Today, we are starting to face some issues that I don't think are going to be resolved in time.
I'm with you. As long as we stay above 41.10, I'm with you on that. As long as we stay above 41.10, I think it's not there yet.
Yeah, this is the line in the sand. We've had this drawn out here for the last week. I've been looking at 41.15. It doesn't really matter. It's above this green line I'm more worried about. But regardless,
I agree. That's my level as well, Blake.
When you're talking about the markets, the thing is we have not been able to carve out a new high in the S&P. And that's that if I was bullish, which I'm not, but if I was a bull, that's what I'd be most concerned about. We do have some big earnings this week. We have Microsoft. We have you guys could probably rattle off because I've been traveling all weekend, so I haven't got them all. I know we have Microsoft tomorrow. We have Google tomorrow. We got Visa tomorrow. Today, after market close, I think we got like Coca-Cola or something like that. Just a few companies, not like anything big, but we are still in the middle of earnings season. They haven't really been that bad yet. But we do have the BOJ this week, which is going to be big. I know you're going to have Jamie from Reuters. He's going to be here talking about the BOJ, I think, which is great. Kman, it's great to get your views here. I'm actually looking at the dollar yen as more of an ascending wedge at this point. I was looking at it as a channel, but we're just kind of keep carving out. Well, we were carving out new highs. Now we're stalling. It is around a 618 retracement. So you can see this resistance here. Let me move that. This, by the way, that's the same level as right here. I just deleted that circle at some point, but you can see we're kind of boxed in to that spike high right there, and the support zone that we had from last week, it actually held when I was traveling, so that held. And so you can see this whole level, I think, is kind of important for the dollar yen going into this week, especially with the BOJ. We could pop our head above, we could break down below. I think it's either or. I think that this week will be driven by what happens with the BOJ. Kman, I know Kman made some comments. I'm sorry, Ryan, did you have any comments about the BOJ this week that you guys might have mentioned on the Flow Show?
Yeah, we just knocked it about. One thing you need to keep an eye on is also Tokyo CPI coming out a couple of hours before the event. It's the first data of April. Last week we got the final or the headline March numbers, so that could add a bit of extra spice. But yeah, pretty much what Kman said. Zero expectations for any policy change. It's all going to be in if there's any language changes in the statement and the updated forecasts.
Awesome. Well, guys, I know. Do we have any news coming out right now? Do you guys know?
I don't think so.
Okay, good. Like I said, I'm kind of it was a early morning trying to get for me. I actually went to bed super early last night, which is great. You know, as soon as I got home at 8, I just was right in bed. But you know, with ForexAnalytix, remember, you got all these great tools. Make sure you check us out. Jump in our community. We have probably one of the most active trading communities, so make sure you check us out. Dale, I know Jamie, is Jamie here yet?
Yeah.
Oh, great. I'm going to pass you over to him. You guys stick around because I'm sure he's got some great commentary about the BOJ. I just want to say thanks, everybody, for joining us this week. It's going to be a pretty busy week in the market, I think. And next week is the FOMC. So we've got, and we have not only the FOMC next week, we have actually the jobs report next week too. It's weird that the FOMC lands on the same week as the NFP. That's not a normal occurrence. Doesn't happen all the time. So should be a fun one. And I want to thank the whole team for being here today. We'll see you guys on the, if you're in the ForexAnalytix community, we'll see you on the Morning Edge in about 45 minutes. Steve, Stelios, Ryan, Kman, Dale, thank you guys.
Thank you, everybody.
Team. Thanks, team. Hi, Jamie. How are you, buddy?
Good morning. Can you hear me and see me now? I'm very well, thanks. How are you?
Long time no speak. You going on camera?
Oh yeah, of course. Give me a second.
Okay. All right, we'll make this like a real news show.
Is that better? Or worse?
Yeah, there you are. How are you, Jamie?
Good, thanks. Looking forward to this. Thanks for having me on again.
You're welcome. We have some things to cover. And
yes, I've just been listening to the conversation. Fantastic conversation. I think you're hitting all the main points there. Debt ceiling is coming on everyone's radar, isn't it?
Yeah, and really the narrative is pretty complacent. You know, they'll be theatrics. It'll get done.
Listen, history would suggest. I think history tells you that's exactly what's going to happen.
Right.
You know, they haven't ever not done it. In fact, I wrote about this a couple of weeks ago, and here's one for you. Here's a question. How many times since 1960 do you think the debt ceiling has been modified, tweaked, or raised, or postponed? Since 1960.
In 60 years?
Yeah, just
60 times.
Not bad. 78.
Oh, so even more than once a year.
Exactly. So on average, so these things, you know, that tells you that obviously they come up with unnerving regularity, but every single time, you know, it is, as one of your panelists said earlier, it's kicked down the road, and especially with an election year coming, you would think that's the case. However, you know, this time, could it be different? I was just, as you guys were talking, I was looking at a chart of a spread between the 1 month and 3 month US T-bills. Now, obviously, that's if it's at the very short end, they're very close in maturity. Right. In normal times, the spread should be a couple of basis points max. Sometimes it goes out to 5, 10, 15 basis points. Do you want it, again, another test for you? Do you want to know the spread on the 1 month and 3 month T-bill now?
50.
I know.
Full point. Okay, these guys know.
Tell me.
145?
180.
80? Ooh.
Oh my God.
So that tells you that the market is clearly, maybe it is looking at this time as different. Certainly it's not taking any chances, and it's, people are piling into the 1 month because it doesn't, doesn't cross over the expected X date, which we think maybe June, July-ish, maybe, August. But the 3 month, nobody wants to touch it. And the spread is just completely exploded. And I think that gives you an indication of how nervous the market may be getting.
So when I was a younger trader, they used to have this thing called the TED spread. They still have it, T-bills, euro. Do people trade the TED, or did just the duration trade take it over? But it was a flight to quality spread, yeah.
Yeah, but didn't that sort of go extinct after the great financial crisis? Was that the LIBOR? Was that treasuries over LIBOR? Was it?
It was T-bills against euro dollars, and they both traded at the CME. The euros traded at the CME, and the T-bills traded at the CME.
Well, I think, again, just before I came on, I was looking at the T-bill OIS spread. which I think may be a kind of proxy for that. And again, you know, you'd expect it, 3-month T-bills and 3-month OIS, you'd expect to be virtually identical. Again, that spread is, I wouldn't say it's blown out, but it's moved out to about 15 basis points, 15, 20 basis points. Okay. Which, you know, for those instruments is a wide spread.
And yet that fear is not being expressed in VIX, in equities, even different bonds like the HYG holding up better than sovereigns. Almost has an outperformance in HYG. Yep. So one side saying take no risk with sovereigns, and everything else I just mentioned says take risk.
Yeah, that's I mean, if somebody can explain to me that, and also can explain to me why the VIX is about, well, last I looked, 16.7, 16.8.
It wasn't this low, even at all-time highs in the market in late 21. It wasn't this low.
It's below the average of almost every single time frame of average you can take since the VIX was launched, I think 1990. It's below the long-term average.
Yeah.
Now, I know that's implied vol and it's not realized vol, and you know, vol experts and stock traders would know this better than me, but so it's not necessarily the best or the only gauge of volatility in the stock market, but it is extraordinarily low, and it does suggest some sort of complacency.
A little bit.
We're talking about the debt ceiling and all these risks, and yet, you know, since the banking shock low of about a month or, you know, six weeks ago, the S&P 500 is up nearly 10%.
Yeah. Now, it meant liquidity in an odd way. It brought, you know, we had easier monetary conditions, so that was a go signal.
Liquidity injections are good for markets. Yeah.
Yeah, I think that, you know, if you're hooked on heroin, you need an injection to be able to function, right? Anyway,
I would guess, but yeah. So I'm not saying dynamics. These are some of the market quirks that we have as we go into, you know, you mentioned some of the events. We've got the Fed coming up.
Talk about quirky. Yeah, let's talk about the Fed. They're the quirkiest bunch around.
Even quirkier than the Bank of Japan?
Yeah, I'd call them pretty quirky.
Well, the Fed, I mean, I think it's, you know, you guys can see the screens. Of course, we're looking at one and done. The market's pricing up, I think, one more hike, which would probably come in a couple of weeks. Or is it next week, actually? Technically, it's next week. Yeah. And that seems to be the market pricing. And then I suppose the question is, well, two questions. One, is that going to be the case? We've still got people like James Bullard. I think he was talking to us last week at Reuters, and he said he's still banging the drum for maybe another 50, possibly even 75. But maybe he's an outlier, and we kind of discount his views, perhaps. Obviously not consensus. On the other side, we've got Austin Goolsbee. He's talking about maybe pausing at this juncture. But I think that if we take the consensus, it's one and done.
He's a new guy.
Yeah.
Austin Goolsbee, huh? He's already couldn't wait for that microphone, could he?
Well, he's taken over. I think I'm right. He's the Chicago Fed, right? And his predecessor, Evans, Charlie Evans, he was extremely dovish. So maybe he's fitting into that slot. But if you take the consensus one and done, I suppose the question is, as it always is, really, is how soon does the Fed pivot and then cut? And consistently, I think last time I was on a few months ago, we spoke about this. No matter where the consensus is for the terminal rate over the last 6 months, year or so, no matter where the terminal rate has been forecast, the implied terminal rate, the forecast has also been for about 50, 75 basis points of cuts shortly after.
Yeah.
And that's exactly where we are today still. We're still looking at a terminal rate of whatever it is, 5.25%, but quickly followed by fairly substantial easing in the 6 months that follow.
So what would be the market reaction if, you know, we get to the terminal rate and instead of going right to easing, we just, the Fed paused for 6 months?
That's a good question. And I'm not entirely sure of what that would mean, but you would think it would probably mean stronger dollar. If the Fed is higher for longer, then you would think it's dollar positive. But that's not what, I mean, we're talking earlier about history. That's not what history shows us. The Fed tends to, almost always tends to move from tightening terminal rate and then quickly, within about 6 months, move to easing. The main exception to that was, I think, 2006, 2007. Yeah, just before the 08.
Yeah.
There was almost a year, perhaps a year or more of plateauing it. I can't remember the rate. Was
because the market held, so they really didn't come in and start easing until the 08 the market sell-off is when they started to do it.
Was that the jobless recovery? Was that what we termed it?
Yeah,
then?
well, that was the GFC. So
yeah,
it took a year after they stopped before we felt the market felt the implications of what they had done. So maybe that's what's happening here.
But that's an anomaly. That doesn't happen normally. Over the last 40 years, the Fed has always turned pretty quickly. And I suspect we would not be in for a year of steady policy this time around.
Okay. Well, what do you think Paul is thinking? He sees the same things you and I do. He sees that spread between the 30 and 90-day T-bill. What's he thinking here with this going on?
Well, we had the minutes of the previous Fed meeting. The Fed last met, when was it? March 22nd, 23rd. That was when the Fed last raised rates. And there was discussion at the meeting of pausing. So it was discussed. Don't forget, that was only days after the banking shock. So it's understandable that came on the radar. It was very much front and center. It will be interesting to see how much that figures into the conversation next week. Obviously, by some metrics, things have calmed down. We've just been talking about the S&P's up 10% nearly. The VIX is down at multi-year lows. Markets seem to have calmed down. However, the emergency programs that the Fed introduced, their lending facilities in the wake of the banking shock, they're still in place and they're still being used, and fairly substantially as well. We're looking at $70 billion each week is being lent out to banks through the new bank term funding program. So that tells you that there's still some stress in the system, and I suspect the Fed will be obviously well aware of that. I think it will figure into their conversation next week. Will it be enough to make them pause? At this stage, probably not unless we get another blow up in the next week or so, the week 10 days. But I think it's very much on the radar. And as we know from history again, banking crises, they tend not to be resolved in a matter of days or weeks.
Exactly. And I think most people, when they say the banking crisis, it's like it's over. And I've heard that there are, many smart guys out there looking for vulnerable financial institutions right now to short or warn their subscribers. And US Bank happens to be one. I think Joseph Wang tweeted about someone that they're definitely a poster child for what happened at SVB and the way it's run. Then I've heard TD America and the bank in Canada is also under scrutiny.
Was that the most shorted bank? That a couple of weeks ago, that was one of the most shorted banks in the world, wasn't it? I think I saw some.
Was it TD?
So, yeah.
Okay, and so. Schwab. I mean, didn't Schwab buy them?
Well, Schwab was in the firing line, wasn't it? About 4 or 5 weeks ago, but that seems to have died down a bit. But you're right. Certainly, some of the smaller banks and the regional US banks are still under pressure.
US Bank is not a small bank. It's not a regional. I don't think they are.
No, sorry.
I mean, they're in trouble, and they're contributing to the bailout for Signature.
Gotcha.
So maybe it gives them, it's good PR. See what kind of shape we're in. We could lend money to a failing institution. That's how great our books are.
So
but that's not what I'm reading.
Well, I don't know.
I have an account there. I have an account there. What should I do, Jamie?
So you've got a vested interest then. Put it into short-term treasury bills.
Okay, you go right to the Fed to do that. I mean, how do people, John Q. Public, retail guys that they're used to money market accounts or CDs. How does the average person get into T-bills? How do they?
You can buy treasuries, can't you? You can buy bills, you can buy treasuries. Retail investors can do that. And if you want near cash-like rates, I think you can go to Apple now and get 4.1%.
Okay. Go where?
Apple have just launched their new cash account. Yeah, so everyone's getting in on the act. I mean, cash is almost 5%. You can stick it into savings. Money market funds, as we've been seeing the last few weeks, money market fund balances are over $5 trillion now. So
you brought up my favorite subject, Apple. Let me ask you something, Jamie. It's your fault. I say this: Apple is the whole banana.
I heard it the first time. Very good, very good.
Oh, you did, but I mean, stock traders and everyone's their flight to safety trade. It's like the gold market is to it's the most crowded owned stock on the globe.
It is, and it's amazing how, as you say, it's more of a safety trade now, isn't it? It's a value trade. It's a flight to safety, liquidity. Only a few years ago, well, I mean, it's obviously still a big tech company. We don't usually associate tech with that, but some of the big tech, mega tech, is now kind of being treated as proxy for safety, for liquidity.
It's the only A. It's the only A in FANG and MAGA that hasn't been taken out to the woodshed.
Yet,
it's the only one.
Well, what tends to happen in crowded trades? They don't always stay crowded.
Yeah, we know how they don't stay
crowded. But I mean, again, maybe the exception. But just going back to the banks, I mean, yes, what I was trying to say earlier was, some of the smaller banks, the regional banks in the US, are still under pressure. I was just looking at this also before I came on. I think the regional banking index of US,
there you
regional
go.
Bank. Well, there you go. It's down 25% still from the pre-shock, and it hasn't moved. I mean, it crashed and it hasn't come back at all. There's been zero bounce.
Okay, all right. So it had a car wreck, and now it's in shock, right? And it's just trying to stabilize, but bottoms are not formed like this.
So what does that?
We could recover. We could recover there. So you talk about the S&P's recovering 10%.
Yeah, nearly 8-9%.
This hasn't. No. I think that this could be the catalyst for either 4,300 if it continues to hold for the S&P, or for a decline in the S&Ps if we start making new lows here. How about you?
Well, I'm not a chartist, but that does not look good to me. I think my basic intuition is...
You wouldn't put your mom's money into the KRE today? Is that what it is, the KRE?
I would maybe wait for the next leg lower before thinking about that one.
Maybe this would be a better bet. It's called Syscoin. I'm kidding. A friend of mine's... oh, look, it held the line. Anyway,
but what's interesting about the small banks and the regional banks is also how it's intuitive, of course, but how closely tied these institutions are with small businesses in the US. Yeah. And you may have seen it pass your screen. A couple of weeks ago, we had the National Federation of Independent Business survey. Not something most of us sort of who look at macro things would have looked at any point over the last several years. But it showed that, again, this was done just after the US banking shock. Sentiment fell in March, as you would expect. But if you look under the hood, some of the numbers, the numbers were really, really quite startling. And I'll just reel off a couple of you just to show how stressed small businesses are in the US and how that link with the small banking sector. If both of them are in trouble, then the economy is in trouble. I would say the net percentage of firms saying now's a good time to expand fell to just 2%, and that's the lowest since March 2009. So none of these businesses think now's a good time to hire or invest. And that's the second lowest.
Well, they can't find employees anyway.
But even if they could, their instinct, their inclination is to not expand, and that's the lowest, the second lowest rather, since the survey was launched. I think more than 40 years ago.
Wow.
And the share of firms, again, the net share of firms planning to increase their hiring was the lowest in 6 years if you exclude the pandemic. And the credit conditions index in that survey was the worst in over a decade. So you put it all together, you put the banking stress in that part of the banking world together. It's not a particularly encouraging outlook for the next, say, second half of the year.
Okay.
And also, just don't forget that small firms in the US, small businesses, they account for about 40% of employment.
Yeah, so it's not a real, it's kind of a toxic cocktail we have brewing here. So
it's
the
one
Fed
to
should
watch,
probably...
and that's something that the Fed will, I'm convinced, will be monitoring very closely.
Okay, so it sounds like there's plenty of economic justification for them to be easing right now.
Well, I'm certainly pausing.
Except for inflation, maybe, you know, the stickiness of certain inflation like food and shelter.
Yeah. No question about that. But I was, again, just before I came on, looking at it's a proxy for sort of commodity inflation and energy inflation and broader inflation trends. It's just a proxy. But if you look at the year-on-year oil price,
Okay.
I'm talking about Brent here, no Brent.
Oh,
so
okay.
So a broader. But if you look at Brent, it may be the same for WTI. The oil price year on year has been negative since the turn of the year. So that's right. 4 months now of persistently negative year on year price action in Brent. It's now about minus 25%. It's got as low as about minus 35, 40%. So the inflationary impulses, if you look at that, are clearly disinflationary.
Yeah.
However, again, obviously there are other factors at play, and inflation broadly has been stickier than maybe the Fed would have liked. But that's worth bearing in mind as we, you know, so base effects are bound to take effect. And again, that's something that the Fed will have inbuilt into their models, I'm sure.
This is an important level, it looks like, Jamie, in WTI that you talk about. This was OPEC's announcement. And
yes, it did spike, and it's come off though, hasn't it?
Yeah, it's trying to fill the gap or coming off. So the next week or so is going to say, tell us whether or not OPEC was successful, or that was just enough for them to get some more oil off for a week or so at better levels. So
not quite short-termism. Well, yeah. as you said, as one of your panelists said earlier in your discussion earlier, the economic indicators have been very mixed in the last few weeks, and so much so that the City Economic Surprises Index has fallen to its lowest in over 2 months. So it's not a big deal. It's not a huge, you know, historic low, but it's lowest in 2 months, and that shows that either expectations were maybe too high, or the data itself has you know, underperformed in the last couple of weeks.
Okay, so hard landing, soft landing, no landing.
I think the no landing stuff. I mean, have we ever had a no landing? There's always been. It's either been
only if you crash, and that's still a landing.
Well, that's a hard landing, I suppose, isn't it? Crash landing.
No landing. Yeah.
Not landing.
Yeah. So really, I think we've covered almost everything that we wanted to talk about, Jamie.
Well, as you say, we've got the Bank of Japan. We've got the Bank of Japan this week, and
yeah,
I think it's one of these things that attention will be focused on the Bank of Japan, no doubt about it. This is Ueda's first policy meeting as governor. It's a landmark one. It opens up a new chapter for the Bank of Japan, if not a new chapter, possibly a new era. However, it's unlikely he's going to you know, kick off his debut policy meeting with a complete overhaul of YCC. So it will all be in the forecast. I think they revise their growth and inflation forecasts. Inflation has been stickier than they would have expected. Growth has been slowing, and it's all in the language and what he says in the press conference. again, it's worth. I think this is worth bearing in mind. If the Bank of Japan indicates that there may be some change to yield curve control in the coming months, which I don't think that would be unreasonable to expect. Contrast that or compare that with the timing of that with, as we were discussing earlier, what's happening in the US with the debt ceiling. If we go into the next 3-4 months with the Bank of Japan on one side making changes to yield curve control, and we've got a brewing crisis here in the US on the debt ceiling, I think that could create some fireworks in dollar yen.
Okay, and we've been trending up in dollar yen. You believe that it'll accelerate it or reverse it? Well,
I think just on the very basic premise of yield curve control change, or a shift from softer, easier policy in Japan to tighter policy,
it would take it down.
Yen positive. Yeah. US debt crisis, possible default, etc. What would dollar yen do? I think dollar yen would probably head to the downside on that one. However, last time I was on, I think I said dollar yen might go down, and it went to the moon. So, take that with a pinch of salt.
It looks like it wants this level anyway. We'll see.
137
happens into about 137-ish. It breaks through that, Jamie. I think we'll see a 140 handle. That would imply the guy does nothing new, and it's same as it ever was, right?
Well, he has said his few public comments so far have been that he's going to take it steady as he goes. There's going to be no major abrupt change, and easier policy will persist for now. But we all know that the pressure, especially in Japan, to have some sort of change is certainly building. And he might want to make his mark and make a break from the Kuroda past of 10 years of super loose policy. So again, I think it's worth watching the timing of that, what they do in Japan versus what's going on here with the debt ceiling. If any of that overlaps or coincides, dollar yen could get very interesting.
Okay, well, when economics look like a voodoo science and you need clarity, you go right to @Reuters Jamie on Twitter. And the best place to read your column, of course, is on Reuters. And really, Jamie, every time we talk, I feel like you've crystallized some things, and you definitely have, brought up some points I didn't know, that there really are some headwinds out there that, that say that the Fed should probably have stayed tight too long already.
Well, as ever with these things, only time will tell. And if it's looking at inflation, it does want to break the back of inflation. It's not broken yet. So, that's why they've stayed on that path, obviously. But there are other factors at play, and debt ceiling, banking system. Obviously, this is the most flagged recession in history, probably. So any slowdown or technical recession will come as a surprise to no one. But these shocks, debt ceiling, and the banking system stress, I think these are going to figure more prominently in Fed thinking, if not as early as next week, certainly in the coming ones.
There used to be a narrative that the Fed wanted a lower stock market. And
when was that? That's before my time. I think that's pre-Greenspan, surely.
No, that was last year, that it was financialized, and that they would have liked to have seen a lower stock market and the speculation and weaken the economy. And now everyone's given up on it. And, in fact, Google stock market crash 2023. And in every year, you'd see hundreds of prognosticators out there making their call. It's going to happen in June. It's going to happen in October. You don't see any out there except Jeremy Grantham. He's the only one I found. So there is a lot of complacency out there. No one's worried about a crash in the middle.
Well, I think maybe doing the Fed a disservice to say that they would welcome a crash. I think obviously clearly they want financial conditions to tighten. They want some of the froth taken out. They want some of the froth taken out the labor market. That's just a nicer way of saying they want more people unemployed. Obviously they can never say that in as many words for political reasons, obviously.
But 3,200
S&P,
3,200 S&Ps would have also put much more of a dent in the upper income for people as far as spending, and they're the ones that still have the money to do it. Yeah, so anyway, we'll see. You know, narratives come and go, don't they? And they say that if you're a forecaster, forecast often.
you might get it right once.
You ever hear that? Yeah, there he goes. Keep throwing that mud against the wall, Jamie. Anyway, buddy.
Thanks, Dale.
Thanks for hanging out with us today. Jamie McGeever, everybody, at Reuters, Jamie.
Thank you. Have a good day, everybody.
All right. Adios, Jamie.
Bye.
Everyone else here could join the team on the Morning Edge. Don't just count your pips, count your blessings. Dollar's weakening. The euro cable spread was the early tell. So we'll see if the market can make hay out of a weaker dollar today. I'll see everyone tomorrow for Turnaround Tuesday. Adios. Thanks again, Jamie.
See ya.
See you, buddy. They're thanking us. See, we edified a few people today. There you go.
Oh, there's a first.
Yeah, mission accomplished.